Good evening, ladies and gentlemen. We will begin the webinar in a short time to allow more participants to join in. And I would also like to remind everyone that you can join in with us via the Zoom link. That is, if you are a registered participant, or you can join via Facebook Live by just visiting our First Capital Facebook page. We'll come back in a moment.
The journey of First Capital began decades ago when we became the first financial services provider of its kind in Sri Lanka. From our inception on, we marked many more firsts, such as being among the front runners to be listed on the Colombo Stock Exchange in 1994. In 2001, subscribed to be the first ever dollar-denominated bond and becoming the first to launch the Platinum Bond and manage Sri Lanka's first AAA debenture in 2014. As well as being the first to digitize account opening for unit trusts and government securities investments in 2021, leading us to become the first in our sector to be listed on the LMD Top 100 and be recognized by Brand Finance in 2022. Today, powered by our philosophy, Performance First, we celebrate this journey with another first as First Capital becomes the first to 40.
Good evening, ladies and gentlemen. On behalf of First Capital, I warmly welcome you all today for our 7th Economic Forum. During this webinar, we'll take you through the First Capital Media Outlook 2022, titled as the Lankan Resurgence. After the presentation, you can participate in the Q&A session where we try to answer as much as possible questions. So the attendees or the audience can post your questions on the Q&A section of the Zoom app, or if you're joining via Facebook Live, you can post your questions on the comment section. Now, I would like to take this moment to introduce our presenters of the day, Dimantha Matthew and Ranjan Ranatunga, who will also be answering your questions at the Q&A session. Dimantha Matthew has over 15 years of experience in economic, fixed income, and equity research, portfolio management, debt and equity financing strategy, project finance, and corporate finance and advisory services. Dimantha holds a Master of Business Administration from the University of Wales, UK, and a Bachelor of Laws from the University of London. He is an attorney at law in Sri Lanka and also holds ACMA and CGMA qualifications. Ranjan Ranatunga has over 7 years of experience in both local and foreign equity markets. Prior to working in Sri Lankan equity markets, Ranjan worked as a senior analyst catering to both buy-side and sell-side funds in the US and UK. Ranjan holds a bachelor's degree from Staffordshire University of UK and also holds ACMA and CGMA qualifications. Without keep you waiting anymore, let's straight away dive into the presentation of our Mid-Year Outlook 2022, the Lankan Resurgence, conducted by Dimantha Matthew and Ranjan Ranatunga. Dimantha, over to you.
Thank you, Vidushika. Good evening, ladies and gentlemen. As you know, it is a tough period for all of us, and this is a very, very challenging time period. So it is very difficult to take investment decisions in this kind of a period. Lots of things for investors to think. So on one side, you have the economic uncertainty coming in and the challenges coming in out of that. And then on the other side, there's a lot of economic reforms that are planned and are ongoing as well. So then on one side, you have again the IMF discussions going on and looking at the timeline of the IMF program. Then also you need to consider the political outlook, how uncertain is that environment. Do we have policy certainty, and for how long are we going to have some sort of policy certainty? So all these questions are lying out there, and we are here to basically take a grip of things and get you to understand how all these aspects are basically going to impact your investments and how we can turn it positively. So let me go into a quote by Peter Lynch. reporting, every time you have one of these recessions, there are always groups who say it is different this time. We won't get out of this one. So if you take First Capital, we have a slightly different view. So we believe that yes, Sri Lanka has come into one of its worst economic crisis, and definitely we will come out of it. And Sri Lanka has gone through multiple challenges over the decades, and we've always come out of these. And in addition, if you take a global scale, there are lots of countries who have gone through these kind of recessions, this kind of challenges, economic crisis, and most of these countries have come out of it. Obviously, it's going to take a bit of time, but definitely with time we can come out of this. So let us not wait too long. Let us straight away go into the presentation. So our theme for the evening is the Lankan Resurgence. Here we would like to basically divide our presentation into three segments. First, we will be looking at the track record, how our past recommendations have worked out. And then secondly, we will be looking at what the factors that are going to affect the upcoming 12 months. And then finally, we will be going into the recommendations section. So let's start off with the track record. So this is for you to understand the levels of accuracy that we are looking at. Anything around 80 to 100% we are looking at as accurate, and 60 to 80% is mostly accurate. Somewhere around the 50% mark, in a range, I would say 40 to 60% is taken as partly accurate. And anything below that is weak accuracy and inaccurate. So starting off with bonds, we believe we are mostly accurate here. In September and Jan, we've expected a very sharp rise in bond yields, mainly 150 to 200 basis points over a period of third quarter of last year to second quarter of this year. And even in Jan, we were looking at a sharp rise in interest rates further to that. However, something important, if there was no IMF or inflows, we were looking at yields to just skyrocket. So that's what we saw during the first half, especially even until now. We are seeing that the yields are significantly moving up. However, something to note that is amidst a political turmoil, even our worst case scenario, we were looking at a sharp rise in rates, but the yields that came about were far beyond our expectations, even our worst case expectations. That's why we've taken it as mostly accurate instead of accurate. So this is how the yields have moved. You can see the sharp rise in yields up to the end of September. And if you look at the month of October, we are seeing all yields moving beyond the 30% mark. Policy rates, we were looking at 2 rate hikes last year and 3 rate hikes this year, altogether around 450 basis points. However, if you take the actual scenario, we've seen policy rate increase about 1,000 basis points. We do have a pre-policy analysis where we do analyze what the expectations are going to be on just before each policy meeting, and there, of course, we've been very accurate in predicting what the policy meeting will do. And however, we've maintained ourselves as partly accurate because the policy rate increase we didn't predict in September and January spike of this much. So bank rates, again, we believe that we are mostly accurate here. Yields have moved up significantly. Only thing is the yields move beyond our expectation, broadly in line with the 5-year bond. And with that, with the 5-year bond overshooting our expectations, the AWPR has also overshot, moving to around 25% now. So exchange rate here, if you take the June figures, we've been accurate here, but we've highlighted ourselves as partly accurate because we didn't really, though we forecasted a sharp depreciation in the rupee did depreciate beyond our expectations of September and January, but after that we've readjusted and we've been accurate there. On the equity side, we would say we were accurate here, mainly because we started gradually reducing equity exposure and increasing cash allocation from mid last year. If you say take August, September, we've reduced equity allocation from 90% to 65, 50%, and then January to around 25%, and by March we had a 90% cash allocation and only a 10% equity allocation. And not only reducing equity allocation, once the market bottomed out in April, we did quickly notice the fact that an increased equity allocation to 50% and a cash allocation was also 50% considering the risk that was involved. So now you can see that we were broadly accurate there as well, with the index moving into the 9,000 to 10,000 range. So let's straight away look at what the key considerations should be for the next 12 months. So before that, let's focus on why we have this theme for the evening, the Lankan Resurgence. So what we believe is that the Sri Lankan economy has hit an all-time low, and we believe that the country is currently at a tipping point. And we feel that over the next 6 to 12 months, there will be a gradual improvement with Sri Lanka entering into an IMF program and inflation also reducing, and all the economic indicators for sort of falling in line. And with that, we are expecting a resurgence in the economy of Sri Lanka, giving rise to hope and opportunity for the investors. So there will be a lot of opportunities, be it fixed income, be it equity. There's going to be a lot of opportunity over the next 12 months for the investors to make healthy returns. So for ease of understanding, we've divided it into 3 specific segments. The factors, so the political, economical, and external. Starting off with the political outlook, we believe that elections are likely to dilute the political stability. So we are rather late here in downgrading our political risk. As you saw, we had a very high risk in the mid of this year. However, we with the possible elections coming in, we are currently downgrading from medium low risk to medium high risk. So after months of process, we are having a new president coming in, and with that, we are having a bit of political and policy stability with the introduction of the QR code for fuel and the reduction in power cuts over time. So, however, it's something important to note that this political and policy stability that we have is temporary in nature, and it is tough living conditions out there, and any kind of problems or protests can restart with the slightest problems coming in. So if you take elections over the next 6 months, we don't think there are any elections in sight, and all political parties also seem to be not interested in elections immediately. But now we see sort of over the last 1 week or so, there is a bit of a sort of a cry for elections, with the tax hikes, of course, coming in. But we don't think the president or the government is looking at elections immediately. However, elections are unavoidable if you take the first half of 2023. So First Capital accurately predicted that local government elections are going to get postponed by 1 year last February. So now the elections commissioner or the commission has announced that local government elections are going to be held before the 20th of March 2023, and that's the legally that's the maximum period that you can postpone the elections. However, we feel that the president or the government may prefer general elections coming before the local government elections, because they may not want to see a situation such as in 2018, 2019, where we had the local government elections, and that trend went on into the general elections as well. And we've seen that happen in the past as well. So there is a possibility that they may prefer general elections coming before the presidential elections. So there is talk of that grounds as well. However, a new development is that the president is also talking about an election amendment in the election law, which of course could lead to a postponement, indirect postponement of the elections. We've seen this happen in the PC elections as well. So up to today, there is no PC elections sort of taking place, with the complexities that have come around due to the amendment of the law. So however, as at now, the current situation is the local government elections are announced, and with that we are downgrading the political outlook here. So let's go into the economic outlook, and we are looking at a slow recovery mode here. Risk level wise, we are upgrading from a high risk level to a medium high risk level, and we think further upgrades are possible towards the start of next year. So on the food inflation side, we are seeing a cooling down effect from June itself. So June, July, August, and even September, we've seen food inflation cooling off. So we've published this presentation before the end of September. That's why you don't have the September figure. And however, if you take the non-food inflation, we've seen a hike in electricity and water, and even the communication costs have significantly moved up, which has impacted inflation, and with it the inflation has moved up, and so the September inflation figures came slightly different to what our expectations, because the part of the electricity hike and the water hike came into the month of September as well. And however, we hold our expectations as it is, and we expect inflation to start declining from the month of October, and we believe it can reach 57% by the end of the year. But the important factor to consider is next year. As you can see, the circled area in the second chart, the second quarter of next year, we are going to see a significant decline in inflation. The primary reason is going to be the very high base effect that we are having from this year. As you can see, there has been a significant spike in inflation this year. Because of that, we're going to see a sharp deterioration in the inflation next year, mainly because of the base effect. And in addition to that, as we are moving into a global recessionary environment, the global commodity prices have eased off, and that is also likely to positively impact us. Also, the possibly stable rupee will also support this situation. So towards the end of the second half of next year, towards the second half of next year, we are expecting single-digit inflation to take place. So we are currently having a hyperinflationary situation, and it is having a significant impact on the economy, and we believe that there's going to be or we already are experiencing a major plunge in private sector consumption, and that is going to lead to negative GDP. So we are one of the first research units to look at or forecast negative GDP towards the end of last year, and early this year was a forecast. So we were looking at 2022, and but current GDP figures we've actually downgraded, and we are more pessimistic than some of the international organizations and central banks. So we are looking at -9% to -12% for GDP, and then for 2023 we are looking at -4% to -6%. So again, you can see that negativity is coming from the significant impact to private consumption. As you know, once private consumption spirals down, it is very, very difficult to turn it around, and it will take a lot of effort and time for it to recover again. And with that, though we are expecting economic recovery towards the first half of next year, still we are going to record negative GDP because of the low levels of consumption, and we are only looking at a positive GDP figure towards the fourth quarter of 2023. So next, we go into the private sector credit section, and to take you through that, and basically most of the other economic indicators, and explain to you in detail, I would like to invite Ranjan Ranatunga to take the proceedings from here on. Over to you, Ranjan.
Thank you, Dimantha. So as Dimantha gave the startup, I'll be looking at the other economic indicators and how it will affect our country's fiscal position as we go into an IMF agreement. So starting off with private sector credit. So we saw 3 consecutive years of private sector credit growth during 2019, 20 period and 21 years. So, and 2021 having the biggest growth out of it of 13.1%. However, going forward, what we're expecting is for this year is a rather small growth of 6.5%. To take note of it, that first half of the year, we saw a growth of 10.5%. benefited by currency depreciation and ballooning effect on the loans, and of people who are taking advantage of the low interest margins before it gets higher and taking on loans. So, however, going forward, we expect this to come down faster to 6.5%, rather relative negative growth in the second half to 6.5%, and in the following year, we expect private sector growth to decline further to 2%. 2%. So another factor that is also highlighted by the IMF that we have to get in order before we sign the board level agreement is the revenue to GDP factor. So during 2018-19 years, we had somewhat of a strong revenue to GDP contribution of around 12 to 13%. However, in 2020 and 2021, we went through a tough period in terms of revenue GDP, with revenue GDP falling by falling to 9.1% and further falling to 8.7% in the 2021 as a result of the very low tax regime that prevailed during the previous government. And also due to COVID, the economy also contracted. So it was a double blow to the revenue to GDP side. Going forward, what we're expecting is revenue GDP to go up to 8.9% in 2022 and to go up further to 9.5% in 2023. Few factors that we're considering in taking into these assumptions is that one thing is, during the month of September this year, we saw that newly elected President Ranil Wickremesinghe adjusted the VAT structure, where the VAT was increased from 8 to 12%, and also the VAT threshold was also reduced from 300 million to 120 million. So also in October, beginning of this month, we saw that personal income taxes as well as corporate taxes are increased. So given that due to the lower collection during the first 8 months of the year, we expect revenue to GDP to jump up marginally to 8.9% from 8.7%. While in the next year, we are expecting the full effect of taxes to come into play, while the economy is also expected to recover relatively from this year. So this is also expected to help the revenue GDP contribution to go up to 9.5% in 2023. So in this slide, what we're looking at is CBSL holdings, or the money printed volumes. So in the month of January 21, we had 736 million of rupees of money printed volumes. However, this went up to 2.3 trillion in the month of August, mostly because of the poor revenue collection that prompted the government to print money, as well as the shot up in the yield curves, where the bond treasury bill and bond yields almost touched 40%. So the central bank had to reject these bids in order to lower the cost of funding. So because of this, the money printed volumes increased to 2.3 trillion during the discussed period. Yeah. So trade balance is one of the key things that we had to look at, given that Sri Lanka is a net importer. So normally Sri Lanka does around 6 to 7 billion of trade deficit in a year. However, this shot up to 8.1 billion in 2021, mostly because of the higher import bill, which ballooned the imports of the country. However, going forward in the current year, we are expecting the trade deficit to come down to 6.6 billion, mostly benefited by the curtailed imports, as well as the fuel bill, which is expected to reduce from the introduction of the quota system. Moving on to 2023, we are expecting a trade deficit to go up higher to 7.6 billion. This will be mainly attributed to the opening up of imports, as once IMF board level is even signed, normally one of the conditions is to open up the country for imports. So we are also expecting that it will be the same case this year, where the Sri Lanka will have to open up its imports. So given the higher imports, again, we will see the trade deficit going up to 7.6 billion in 2023. So one of the key factors that will lead Sri Lanka to recovery is the tourism segment. So in 2019, which was our best tourism year, we saw that tourist arrivals going up to even 2.2 million, while the tourist receipts from tourist arrivals go up to USD 2.2 billion. However, as the world went to COVID, Sri Lanka also went under a big crisis because given that due to a lack of significant funds flowing in from tourism, it was also one of the biggest factors contributing to crisis. So we in 2020 we had tourism income of USD 7.7 billion, while in 2021 it further fell down to USD 0.5 billion. However, going forward, our expectation is that we may see tourist arrivals going up to 751,000 this year. However, we believe that this is a bit of an optimistic case because in the first 8 months of the year, we saw a drastic slowdown of the tourist arrivals due to travel adversaries placed by our key tourist destinations. So, given on the basis of that, we assume that for 2022, we would see tourist arrivals of 751,000 while earning a total income of $1.1 billion. However, going into the second year, we are expecting a massive revitalization in tourist arrivals, where we are expecting 1.2 million arrivals to come in, generating 1.9 billion of foreign exchange income to the country. Few things that we are targeting as growth factors for the increase in tourist arrivals is one is the factor that Sri Lanka has become, with the depreciation of the rupee, Sri Lanka has become one of the cheapest destinations to travel in terms of airfare when taking consideration the airfares from the Europe and as well as Asia. Also, as we all know, the Europe is undergoing a massive inflation crisis right now because largely led by the gas bill. So according to, we have done a small calculation. Based on the calculation, what we have seen is that rather the amount that a normal household in Europe will spend on 3 months of winter season is it would be coming to Sri Lanka would be much cheaper compared to the gas bill that the household will be spending on if you are spending at Europe for the winter season. So this is also a key driver for tourism growth in Sri Lanka. So another key factor that we are looking at is the worker remittances that is flowing in. So usually Sri Lanka does around 6 to 7 billion of worker remittances. However, in the year of 2022, that is the current year, we expect this to fall down to 3.8 billion. This is mostly because of the steep depreciation rupee and all the workers who are remitting money to Sri Lanka is opting to fund money through unofficial sources because of expectation that the rupee will depreciate further. So this year we are expecting a drastic slowdown in foreign remittances to 3.8 billion. However, going into the next year, we are expecting worker remittances to go up to 5.8 billion, mostly benefited by the narrowing down in gap between the unofficial and official channels. So we are, as we currently seeing right now, the gap has already narrowed. It's already somewhere around 10 rupees, the difference between the unofficial and official channel. Balance of payments is, so take into consideration all the economic indicators that we had discussed before. Balance of payments arrives because of that. So for the current year, we are expecting a balance of payment deficit of 1.1 billion. And and moving on to the next year, we are expecting a balance of the balance of payment surplus of 1.3 billion. So few factors that we are taking into consideration when arriving at the surplus in the next year is that we are assuming that the IMF, we are expecting the IMF to IMF board level agreement to be signed in the month of February. So with this, we our country's ratings will increase, and more following the IMF path, more multilateral agencies will come and funding will flow to the country. So we have already seen this happening at the ADB, where ADB has already promised 500 million to our president after the signing of board level agreement. So taking with on the back of coupled by the strict import policy, as well as new funding coming from multilateral agencies, we expect the balance of payment position to strengthen to 1.4 billion surplus for 2023. Yeah, so the reserves normally goes hand in hand with the balance of payment. So for the as of December 2022 end, we are expecting the reserve position to rise up to 2 billion, which is currently hovering on a 1.7 billion, including a Chinese surplus 1.5 billion. And after the IMF agreement is signed in February, as our expectations, we expect the reserve position to go up to 2.5 billion. And to close the year at $3.5 billion. So this is also, as I said before, considering the funding that will flow through the multilateral agencies to support the country to come out of this crisis. So this is just a small part that we have highlighted where the IMF agreement has begun, and receiving of the money that is expected to flow into the country. So as you all know, in April 2022, Sri Lanka first went to the IMF to discuss to arrive at an agreement. In September 2022, Sri Lanka finally agreed on a staff level agreement with the IMF, and after that, the restructuring talks are underway, where we are expected to meet the creditors and discuss and arrive at a sustainability plan to obtain the money. So based on that, we expect in January 23 the IMF board level agreement to come in, and during January 2023, that month itself, we are expecting the first tranche of money to come in from IMF. Meanwhile, along with that, as the debt restructuring talks progress, we expect substantial level of debt restructuring to come to arrive at February 23. So with this, given that IMF is happy to release some funds after we reach substantial level of debt restructuring, we are expecting to receive the second tranche of money from IMF in the month of May 23. Yeah, so this is a slide that will highlight how we have arrived at a IMF facility. So as you all know, Sri Lanka went to the staff level agreement in the month of September for a fund facility of $2.9 billion, an extended fund facility spanning for 48 months or 4 years. So before IMF starts handing out our money, they have highlighted a few key things that we had to look at in order to arrive at a board level agreement. So one thing is the electricity tariff revision. So as we all know, CEB is making massive losses, made massive losses due to the non-revision of tariff structure for 10 years. However, we have got the new revision, we have properly implemented the new revision, so we can tick this precondition off. However, the remaining preconditions are the challenging ones, where it is also advised for the government to absorb the loss-making loans and losses of SOEs. So they have highlighted few of the key highlighted SOEs are the CPETCO, Sri Lankan Airlines, and the CEB. That is, so the talks are still on the way, and we are still waiting for some progress on the on absorption of losses of state-owned enterprises. Then the introduction of a new CBSL Act. So we first heard something regarding to this on the interim budget that are presented in the month of August by the new president. However, we are yet to see anything materialize on this factor. So this also remains still to be done in order to achieve the board level agreement. Then next is interim budget. So as I said to you before, we saw the interim budget for the year of the remaining period of this year presented during the month of August. So with this, we can also tick this off. Then the final and the biggest factor is the debt sustainability factor. So this is a key factor that is highlighted by the IMF in order to sign the board level agreement. And currently Sri Lanka, as I said to you, currently Sri Lanka in talks with creditors to achieve this as soon as possible. Yeah, so I want to put in this because as IMF suggested, we had to do some key reforms. So for instance, fuel price revision was also one of the reforms that were pushed by the IMF, and also the electricity tariff structure, as I said before in the previous slide. Then moving on, after all the expenditure and income is taken into consideration, the budget deficit comes. So for the year of 2021, we saw a budget deficit ballooning up to 12.2%. However, going into 2022, we are expecting the budget deficit to come down 12%, and in the following year come down to 8.8%, benefited by the new the tax structures as well as the economic recovery that is expected to happen from the year 2023 onwards. Yes. So the next part, I would like to invite Mr. Dimantha Matthews again, who's our specialist in debt, to take you through debt and how Sri Lankan debt will be restructured if it's going to happen. Over to Dimantha.
Yeah. Thank you, Ranjan. So talking about the debt situation, as you know, debt has been the biggest problem for Sri Lanka, and that is the sustainability is the biggest challenge. So in line with the graph, what we say is that China and Japan have the biggest portions in terms of debt. However, there is a bit of a older set of numbers that we could find. Currently, the Indian composition has significantly increased over the last 3 to 4 months with the significant amount of support that India has given. However, 47% is, of course, the market borrowings, that is mainly the ISBs coming in, international sovereign bonds coming in. So we all know that we had a massive rupee depreciation in the month of March and April, and what has it done? It has significantly increased the foreign debt component for Sri Lanka. As you can see, 37% in 2021, and now it's estimated at almost 50%. So the domestic debt to foreign debt segregation or the ratio is now almost 50-50. And with it, we estimate that by the end of this year, debt to GDP has surged past the 130% mark. Of course, this is highly reliant on what we will end up as the nominal GDP figure. So with this high level of inflation, there is a bit of a confusion there. However, we know that it's a very, very high number. In addition to that, now if we go through the debt restructuring, then only we will have some sort of respite coming out of it, and it will come to a sort of a manageable level. So foreign debt is not our only problem, right? we have a large chunk of domestic debt or debt repayments piling up over the next 2 years as well. So you can see the amount doubling from 22 to 23, coming to 1.2 billion to 2023 and 1.1 billion in 2024. So overall, this is only treasury bond maturities. So you can see that they're piling up close by. So let's talk a bit more of debt restructuring. So there's a lot of talk about debt restructuring. This is a chart from the IMF and compiling the last 25 years of debt restructuring that different countries have done, both domestic debt restructuring and external debt restructuring. So some countries have done both, some countries have done one. So as you can see, the highlighted square, which shows the duration. So roughly about 2 months to 24 months is taken to complete a debt restructuring process. If it's only domestic debt restructuring, usually it has taken shorter time period. Some countries have done only domestic debt restructuring, but when there is external debt restructuring, because of the extensive level of negotiations that occur, it usually takes a longer period, and on average you could say that this takes about at least 12 months. So next year, second quarter would be the earliest period that you would be seeing the completion of the debt restructuring. So either it's earliest would be around the second quarter of next year or beyond that. It's what we are looking at. So what kind of debt restructurings are there here? We're looking at domestic, but this can be applied to foreign debt as well, especially the bonds. So here, basically, we are looking at there could be a reduction in the principal amount paid out, so which we call a haircut on the principal. So the amount of money or the capital that is going to be returned to you at the end of the period, there could be a cut on that. Then the biannually what you get, the coupon, there could be a cut on the coupon rate. That is a cut on the interest rate that you get biannually. But the important thing to note here is that 92.5% of the treasury bonds that we have yield 12% or lower. Or in another way, if you look at it, the average coupon rate outstanding is around 10.61%. This is as at June 2022. So basically, if you look at in that way, you can say that our coupon rates are actually onto the lower side. Then third option is to increase the maturity period. Like if it's a 5-year bond, you extend it to 10 years. Then you can do a hybrid of the above options. So how likely is local debt restructuring? So that's an important thing to consider for local investors. We think the possibility of local debt restructuring stands very, very low, and we put it at 20% probability. Now, why do we say that? Because so on one side, you do have the argument for debt restructuring coming because of the high level of gross financing needs, which means how much money you need to raise during a particular year, including the debts that you roll over. So that amount is currently exceeding 25% of GDP. And the recommended level by the IMF is around the 15% mark. And so you can see that there is a substantial gap providing a justifiable argument for local debt restructuring. However, we have problems while doing local debt restructuring. What is that? One thing is, so you can see in one of the IMF papers itself, it says that there is a very large portion of debt owned by the banks. And because of that, if we do domestic debt restructuring, it could have a significant impact on the financial system stability. So it's not really advised to do local debt restructuring. On the other hand, the local investors have already suffered, say it a foreigner or a local investor who has invested in rupee investments. Because of the currency depreciation and the high inflation level, your buying power has actually halved. So what you get out of that investment, the capital that you get out of that, what you can buy in the market is half the value. So because everything has moved up in value because of the depreciation. So that accounts for sort of like a haircut. So it has significantly deteriorated the buying power. And third argument is that if you, since there's a lot of debt owned by banks, there could be a requirement to recapitalize these banks if you go for a local debt restructuring, and that may significantly affect the budget deficit of the government, because the government may have to fund some of the banks basically, so to recapitalize them. So this is going to be a huge problem. So we think that because of these things, the possibility of local debt restructuring is pretty low. Next, let's look at the impact assessment if there is a local debt restructuring. So our base case scenario, we are looking at 4 possible things. 10% haircut on principal, 10% haircut on coupon, 3-year maturity extension, or a hybrid instrument, that is a 10% haircut on principal and 3-year maturity extension. So here we are looking at a 2-year bond and a 3-year bond. So as you can see, the impact is pretty significant when it's shorter tenor maturity, somewhere in between 1.73% to 13% for the 2-year, and 2.2% to close to 6% for the 3-year. However, if you consider the 5-year and the 10-year, you can see the impact is significantly lower. That is, it comes to around 1.5% to 3% for the 5-year, and 0.45% to 2.8% for the 10-year. Now let's look at sort of like a worst case scenario. So here we are looking at a 20% haircut on principal and 5-year maturity extension. And the second scenario is an extreme situation, like a 40% haircut on coupon and a 5-year maturity extension. Now here you a 40% haircut on coupon throughout the period doesn't usually happen. Globally, what we've seen in the past is that there is something like a step-up coupon. That is, you don't apply the lower coupon rate to the whole period. Now, if you take a 10-year bond and you have extended it by 5 years to a 15-year bond, the coupon rate will apply as a step-up approach. Like, for example, probably the first 7 years, if the coupon rate is 18%, say for 7 years, coming to around a 10% coupon, and second 3 years probably giving a say a 15% coupon, and then moving back to the original rate of 18% coupon. So that's how you usually a step-up approach works. And so this is an extreme scenario that has sort of rarely happened. So usually it will be a step-up approach in terms of coupon. So you can see again the impact is significantly high here. Let's look at the 5-year and 10-year. Obviously, the impact is significantly lower. And if you do apply for the second one of 40% haircut, step-up coupon approach, you can see that your loss goes below the 10% mark as well. So that means if you do invest at the current rate of 30% plus, you will still end up with a yield of 20% plus, which is still good enough. So here, what we are looking at is the local bond repayments. So these only bonds taken into account. You can see that the pressure is significantly high. Only in the second quarter of next year does there is some relaxation. So that is exactly the period where the inflation is also going to significantly come down. But all the other periods, you can see that there's high level of maturities coming in. Not that all this might get rolled over, because remember that we are going to have a higher level of taxation as well. So there could be some of these being paid off as well. So here, this is sort of like a summary of all the indicators that we went through. So when we looked at this in January, if you do remember, we had only one positive and so many negatives. Now you can see that there is sort of somewhat of a balance between the positives and the negatives. So let's look at the external outlook. There is somewhat of a improvement that we are looking at. So we are upgrading from a high risk level to medium high risk level. And so here we are looking at the global recessionary environment. We feel that it is a blessing on Sri Lanka. We think it will significantly favor Sri Lanka. On one side, it will limit the rate hikes that the Fed will come up with during next year because of the hikes that have been put in this year. We think that there could be some softening of US inflation, and with it global inflation may also soften, and because of that there could be lower level of hikes coming in next year. And the other more important factor is that commodity prices, because of the recession, are coming down, and we don't think the recession is going to end anytime soon. And because of that, it is likely to stay low and may move even lower, which is a very positive scenario. So international sovereign bonds also have a slight eased off. We saw it over the last couple of days. Of course, I'm slightly moved up again, but overall is lower from the peak. Foreign inflows, positive factor here. We are seeing in the CST primary and secondary markets significant levels of foreign inflow coming in, and more importantly, the treasury bills and bonds segment. There seems to be more interest, foreign interest now coming in, which is a very positive factor. Then again, now once we complete the debt restructuring throughout the world, what we've seen is, since there's lower debt over the next 5 years, there is usually an upgrade in credit ratings. So usually this happens about 2 notches or 3 notches up. So we can expect in such a situation, Sri Lanka's credit rating to move up to around CCC plus, or even if you're lucky, B minus, which will open up the capital markets for us yet again. So this is again the summary of the external sector, so I will not go into detail. Here is the overall outlook. Of course, we've downgraded the political side and upgraded the economic and external outlook. Let's quickly go into the recommendation section. So the last few slides, and we can move into the question and answers. So on the bond side, so those of you who've been with us during the past 7 economic webinars, so we have something called a First Capital Fixed Income Health Score. And basically we monitor all the indicators that impacts interest rates. So here are the primary criteria that we are looking at. So if you can remember, in the month of January, when we were doing the forum, all of these were at high risk level, but now you can see some easing off the credit, the foreign activity, now inflation. Over the next couple of months, we start easing off liquidity. We are seeing some sort of improvement. So over the next few months, we will see further improvement there. So secondary criteria also, all these were in high risk areas, but now you can see that things have significantly started to improve. Then main thing is the external environment. The rupee is more stable. BOP is improving significantly. Ratings outlook may improve with the IMF coming in, and so on. So what we saw is the current situation. This is the forecast. So you can see a massive upsurge in the fixed income health score in the coming months, starting from September. So even in the month of September, with the credit improving, we are seeing a significant improvement now with inflation and other indicators starting to improve in the month of October. We will see a significant spike in the health score, which is reduced, which will reduce the pressure on interest rates and start to push interest rates downwards. And towards December, you can see we are crossing the high risk level to medium high risk level. So with that, you can see that once we get the IMF board level also, that will further improve things. Without that, other indicators are slowly improving at the moment. So policy rates, what's our expectation? So we think policy rates are likely to be stable throughout the fourth quarter and the first quarter of next year. However, we think there is now probability to lower level of probability though for rate cuts. We've eliminated all probabilities for rate hikes now. We think there is more probability for rate cuts now, but at a lower level during the fourth quarter and the first quarter, 10 to 20% range. If the central bank decides to give a rate cut, even it will be only about 25 basis point rate cut, only to indicate the direction that interest rates should be moving in, nothing else. And in terms of rate cut, we are looking at only the second quarter of next year. That also a big one, 150 basis points is what we are looking at. Excuse me. Yeah. So we think bond yields are very attractive at this moment of time, and so as we explained, debt restructuring possibilities are very low. Yields are extremely attractive even if there is local debt restructuring, and we feel that you should be moving into long tenor bonds, and you should at all costs try and avoid the shorter tenor maturities. So what is the short-term direction? So we think it's going to be volatile, but it's going to be a volatile downward trend. That's what we are looking at. Why the volatility? Because though we do have this IMF sort of coming in, debt negotiations, or trying to get everybody into the debt table, then inflation coming down, all these things are happening. But there will be always that haunt for investors that there could be local debt restructuring. So because of that, always time and time again, you will see that selling pressure coming in, and with it, volatility coming into the market. On a broader view, long term, we think it's time to be cautiously optimistic in terms of bond yields over the next 12 months. And with IMF board level also coming in, and probably debt restructuring completing. If you take 1 year from now, all of those will be completed, and we may have some sort of political side stability also. So in such a situation, we will have significantly lower levels of yields. So where would the yields come to? We are looking at yields coming to 22 to 24% for 1 year. This is for December, this December 2022, and 21 to 23% for the 5 year, 22 to 22% for the 10 year. However, then first half of next year is very, very critical. Here we expect debt restructuring to get completed. Then we have the IMF board level coming in. All that is there. So we are expecting yields to come down to around 15 to 17%. Within the whole yield curve will normalize and come down. All three, the whole yield curve will come to a range of 15 to 17%. So this is a scenario that we've developed to explain to you the attractiveness. So the bottom band that you see is the range that the yield curve range that we are looking at as at December. Now the shaded area on top of that is the loss that you may incur if there is a rate cut. On an average, we were looking at for the shorter tenors somewhere around 8 to 10%, for the mid tenors probably about 5 to 8%, and so around 6 to 8% for the 5 years to the long tenors. So basically, you can see that if you look at a 5 year or longer tenor bond, still there is a gap in between the shaded area and the current yield, which means that even if you have debt restructuring coming in, you will be better off. You would have gained, basically. Now, so this was done about 2 weeks ago. Now you will see that the yields are even higher and all above the 30% mark, which will give you even a higher profit level. So as we are continuously explaining, we are telling that we are recommending investors to buy into bonds, especially bonds beyond the 5 year. So banking rates, we don't think the AWPR will come down anytime this year because of the debt restructuring that may affect the banks. The banks are reluctant to sort of lend, especially with the current economic situation as well. So, of course, there is a delay also. Usually, it moves in line with the 5 year bond, true enough, but there is a sort of a 6 months lag. So we think rates will still hover around the 25 to 30% mark by the end of this year. However, when you move up to the June next year, we are looking at 21 to 23% and December 16 to 18%. So exchange rate, basically we are looking at, here we have changed our view a bit. So we are no longer expecting the currency to appreciate, because it's not a prudent approach to appreciate the currency of a bankrupt country, because you will worsen the situation. Now, what is the more prudent approach is, if there is excess dollars coming into the country, the central bank, without allowing the currency to appreciate, you can always buy the dollars out of excess dollars out of the market and keep the rupee to dollar exchange rate stable. And with it, you will be automatically building reserves as well. So once you build reserves, the currency will automatically strengthen. So that is the more appropriate thing to do at this moment of time. So we think the currency will be more or less stable this year, and especially towards the first half of next year. We are looking at a marginal depreciation towards the second half of the year, with IMF coming in and trade relaxations coming in. There could be a bit of a marginal depreciation, but broadly we are looking at a mid rate of around 380 still at the end of 2023. So you can see that we are looking at the currency being stable for a longer period of time. And so if you look at a range, we are looking at 345 to 415 for the exchange rate. So next we will go into equity, and so to take you through the equity recommendations, I would like to hand proceedings over to Ranjan, who will take you through the equity segment. Ranjan, over to you.
Thank you, Dimantha. So we have arrived at the final section of the presentation here. So if you have been following our research report during the last few years, we have been providing recommendations on how to invest on with the movement of SPI. So based on the June report that we put out, we were expecting the SPI to drop and touch 7,000 levels because of the crisis that prevailed in the country, and including the fuel shortages and the operation disruptions. However, given that the companies were doing well despite the performance, despite the crisis, we are expecting, although it will drop below 7,000, for it to bounce back to 9,000 again. So as of our predictions, this proved accurate, because we saw during the month of May the index falling and touching down around below 7,000 levels, and during the month of June, July, it climbing back around 9,000 levels. So these are the few fiscal consolidation impacts that we expected to come in as the crisis emerged. One thing was, and a few of the mitigation factors that we can also see that is coming in. One thing is, most of all, we were expecting the tax regime to go back to 2019 levels, because we saw tax revenue to GDP going up to around 14 to 16, 15%. So we were expecting it to go back to 19 levels. So it has happened. Then revision of value-added tax, personal income tax, and corporate tax structures. So as I discussed before, from during the month of August, we saw value-added tax rate increasing from 8 to 12%, while immediately that threshold was also reduced from 300 million to 120 million. Meanwhile, in the month of October, President Ranil Wickremesinghe came forward and introduced a few other taxes, including revision of corporate taxes, which was at a standard rate of 24% to 30%, while also the concession industries, including tourism, was brought up from 14 to 30%, while manufacturing was also brought up from 18 to 30%. Meanwhile, in terms of personal taxes, what happened was, earlier we had a tax-free rate of 250,000. So this threshold was brought down to 100,000. So with this move, the tax net was broadened and more people will pay taxes. Furthermore, what we saw was under the previous regime, personal income taxes, the maximum it was went up was 18%. However, this was doubled to 36% with the new adjustments. Finally, what we are looking at is the impact the new tax structure will bring into consumer demand. So as we are currently seeing, the taxes with the implementation of taxes, the disposable incomes of people fell down heavily, and it has reduced the buying power of people in Sri Lanka. So in this slide, what I have planned is I like to highlight a few shocks that we went through during the last couple of months. So ballooning of finance cost was one of the biggest factors where we saw during the last quarter corporate earnings, most of the companies recorded the finance cost almost doubled. So this was as a result of the ballooning finance cost and surge in AWPLR. Meanwhile, with the revision of tariff structure for fuel and electricity, we saw energy cost also rising for corporates, and we saw this happening in the last quarter report as well. Meanwhile, what we are yet to see is the eroding of buying power. So we saw already have seen the currency and the inflation impact coming in. However, the tax impact we will see it soon. So one thing is one thing to look after is the eroding of buying power when it comes to shocks that can be expected in the future. Meanwhile, I'm happy to say that we have gained a lot of good positive momentum in terms of operational disruptions, where we used to see 13 hours of electricity cuts. So this has come down to one or 2 hours now. Moreover, in terms of distribution, due to lack of fuel availability and the long queues that we had, most of the corporates and the majority of operations around the country was disrupted due to the inability to distribute the products. So given that with the introduction of quota system, the fuel queues has largely dropped down now, and we are seeing corporates almost back to their normal levels of distribution in terms of products and services. Meanwhile, the final factor that we had to see is the tax hike. So as I discussed in the previous slide, the corporate taxes as well as personal income taxes was also raised. So this will have the domino effect on the buying power of the customers going forward. So when it comes to earnings of corporates, so what we earnings of corporates. So this year, year to date, we have seen corporates recording almost high as 22% in terms of earnings. However, with the introduction of new taxes and reduction in disposable incomes of customers, we are expecting it to close somewhere around with a growth of 20% in the current year. And in the following year, we are expecting it to drop to 18%. So this will happen because that so next year will be the year Sri Lanka will face all the taxes at full. So given that, as well as given that on top of the reduction in GDP also, so given that we are expecting the earnings to come down to 18% levels. However, in the following year, in the year of 2024, we are expecting earnings to jump up to 20% as IMF steps in and the fiscal consolidation start and the recovery in the GDP happens, while we are expecting massive salary adjustments also to come in from next year, which will also have a positive impact on the buying power of people, thus on the corporate's earnings. So based on our assumptions, we are expecting ASP to reach 12,000 levels by 2023. So this is mostly on the back of IMF coming in and the possibility it will build around that. Also, and the recovery in the GDP, as well as purchasing power of customers, which will be adjusted to the adjustment in wage structures of private companies. So with this assumption of index hitting 12,000 levels by 2023, we have advised our investors to increase the equity portion allocation from 40 to 50%, while this will prompt the cash allocation to come down to 50% from 60% levels we advised before. Finally, in this chart, what I like to highlight is that 12,000 is a long way ahead. But however, this 12,000 we won't achieve this through a complete bull run. We will see volatility at the beginning till signing of the IMF board level agreement, and from there onwards we will see a solid uptrend and a slow uptrend reaching 12,000 levels by end of 2023. So so this is our expectations on the both the economy and the market. Finally, I would like to close with how demand with the same demand open. So there will be a lot of people who will be have opinions on the market. However, only the brave and the bold will prosper, because they will be the ones who will be only the bold enough to invest in the market and gain in the current momentum. So I like to also say, be brave and invest, but always invest in fundamentally strong shares and see your wealth grow while the index also goes and touches 12,000. So that's all in the presentation. Thank you, and I'd like to hand over the presentation back to Dimant again for the Q&A session. Dimant, over to you.
Thanks a lot, Ranjan. So myself together with Ranjan, we will look at going through the questions that you have, and so as you can see that there is a lot of things to consider when you're looking at the next 12 months investments, and also as we explained, it is a great opportunity in the current period to correctly look at the market and do your investments in an appropriate manner. So let's move into the questions. So we have some live questions. I think we should take up the questions that have come through the registration first, Ranjan. Let's go through those. Yeah. So first question is that following Sri Lanka's downgrade to a low-income country, what concessionary loans could we expect in the near term? So it is like this. Now, Sri Lanka, when you say when Sri Lanka gets downgraded to a low-income country, like in the period that we were during the last decade, like 2000 to 2010, and even up to around 2013-14, if I remember right, we will qualify for concessionary loans, and most of these concessionary loans are given by multilateral organizations like the ADB, the World Bank, IIB, that's the Asian Infrastructure Bank. So like these multinational institutes only basically give concessionary loans. Most bilateral loans are not concessionary in nature. The lowest cost loans are these loans coming from these multilateral agencies. That's why you really can't basically restructure the loans that are relevant to these multilateral agencies globally. In a debt restructuring assignment, we've not seen loans that are relevant to these institutions getting restructured. So though we still get loans from World Bank, ADB, and so on, those are at a higher rate compared to low-income countries. So we should be able to get far lower interest rate loans when we are downgraded to the low-income regime, and basically the advantage is we can replace existing loans with these low-cost loans if they allow it. Yeah. So there is a question related to the stock market. Basically, so Ranjan, if you can take it up, future opportunities in the stock market, and when will the market recover? Two questions. I think we can take it up together. Yeah.
Yeah.
Ranjan?
So as on the question that Dimantha explained, what I say is like, so as I had presented before, we are expecting the index to reach 12,000 levels by 2023, and what we are advising all our investors is that to position themselves in fundamentally strong shares. So few of the sectors that we are recommending is the defensive sectors, which have high dividend yields, such as Chevron and all, and then you get the utility segment. Furthermore, we have the tourism sector, which is expected to pose a massive growth with the recovery in tourism in Sri Lanka, as well as moving on to the next year. We will be looking at after signing of board level agreement, and while the debt restructuring talks have also complete, we are expecting the banking sector to also run, because right now the banking sector is trading at a highly discount. So it's trading at around 0.2, 0.3 times. This is in my experience, this is the lowest it has traded in the history as well. So if we can once the debt restructuring talk subsides and it finishes, we will see banking sector shares moving as well. So it will be if you can position yourself in these shares, I think you will be able to enjoy good returns in the short to medium term.
Yes. Also, I think energy sector was something that we were significantly recommending, things like LIOC, Chevron lubricants, which is also high dividend yielding stock, like Ranjan mentioned earlier. So these are some of the items that you could go into. So why these are important? Even LAF gas could be another option that you could go into. So why these are important is globally, if you take these kind of economic crisis situations, globally these sectors have performed because naturally you have to come up with reforms, then you have to reprice your this kind of items, and because they are given at a subsidized rate is one of the key reasons for crises to occur. So in addition to that, you could even look at the food and beverage sector as well. That is mainly for next year, because we are looking at somewhat of a recovery in the economy and disposable incomes levels, as Ranjan explained in the slides. Yeah, that's about it. Next, there's a question on debt restructuring again. Any concern about local debt restructuring? And another question on whether bank FD rates have peaked. So I'll take up those two questions together. So in terms of local debt restructuring, as we explained, so we believe that the probabilities for local debt restructuring is very low. Also, there's a question on the timing. I will talk about a bit about the timing because the governor explained to this in his presentation to the creditors. So here what he explained is that once we achieve a substantial level of debt restructuring, which means what does substantial progress mean? It means that if you can get all the creditors to agree to come to the table of debt negotiations, that is considered as substantial progress. Once we achieve that, then if the preconditions obviously are met, then there's a high likelihood of Sri Lanka achieving the IMF board level agreement. So afterwards, once IMF board level is done, then we go into the negotiation, debt restructuring negotiations with the foreigners. So so at that moment of time, there will be multiple scenarios because so you'll be having negotiations with the ISB, international sovereign bond owners, then the bilateral negotiations will take place. So once those negotiations are concluded, then you will have to consider the scenarios at that time as to how much of local debt restructuring is required to achieve debt sustainability. So it's highly dependent on how much success you will make in foreign debt restructuring. So, and also it will go beyond March is what the central bank is informing us. So before March, they are looking at finalizing or getting everyone onto the table and achieving. So during the first quarter, we are trying to achieve the IMF board level with the preconditions and getting everybody onto the table. And then secondly, we're looking at debt negotiation. That is what might take a bit of time because especially India and China, the negotiations are likely to be tough. So there's another question on the economic recovery. Can we expect the economy to recover at least by the first quarter of 2023? Ranjan, you want to answer that question?
Yeah, so as we have been discussing now throughout presentation, we have been so with the new tax structures that have been introduced to both VAT and corporate taxes, as well as taking into consideration the high inflation also prevailing, we may see a slowdown in the first quarter itself. However, once the IMF board level agreement is signed and the funding from multilateral agencies started flowing through, we may see the fiscal side of the country getting back to normal again. It's on the path of recovery. In terms of disposable incomes, we are expecting good salary adjustments to come in during the month of March, because most of the companies, the dollar earning companies, have already adjusted their employee salaries. However, we are yet to see the local companies adjusting the salaries to tackle the inflation. So once this steps in, we may see disposable incomes growing as well. So with this, we are expecting the recovery to start from the second half of the year of next year. Anything you need to add on, Dimantha?
No, I think that's it. We will go on to other questions. I will just leave the questions that we got from at the time of registrations, because we have a number of questions in the Q&A section in the Zoom. One question is, your resurgence expectations are based on IMF agreements falling into place by early next year. However, key creditors, China and India, have not given any positive indications of favorably considering debt restructuring. Given their domestic economies are also challenged based on the current global events, isn't it correct that IMF would proceed only once all main creditors are in sync for debt restructuring? And there's a continued comment there. If China and India consent is delayed, then recovery would get protracted. So basically, it's like this. In terms of the economy, we would already see inflation coming down, liquidity starting to improve. We are already seeing that right now. So we are going on a controlled level of imports. Now that is what's giving us the positivity at this moment of time, because we have the BOT and BOP under control. Don't forget also that we are already starting to see increased level of worker remittances and possibly higher level of tourism earnings. So all these positive factors are going to impact the economy. Now, what is going to delay here? Yes, China and India negotiations are going to be tough. Getting them onto the table also will be tough. But something important to note on a global scale is Zambia most recently have managed to get these countries onto the negotiation table, and the negotiations are currently taking place after entering into an IMF agreement last December. So by July, they managed to get these countries into the negotiation table, which is actually a positive sign for Sri Lanka that China is willing to initiate negotiations. So we feel that considering our relationships with these two countries, which are sort of strategic relationships that we have, and there is a high possibility that we can get these two countries especially into the negotiation table over the next 2 to 3 months. So yes, it's going to be tough, but we feel that by around the first quarter we can get what will happen as a benefit to us is that IMF of course will come faster, and the shortages we can open up the economy, and the shortages that are existing in the system of course might ease off pretty quickly if the IMF comes in. If not, still it will ease off, but it's going to take a bit of time. So what will happen is, if the IMF comes in, we will have an accelerated level of relaxation that we can buy the foreigners, where they will also, we expect them to come and move into Sri Lanka, into the equities, into the fixed income. That will help basically boost our reserves. So that's what we expect. So next we have a number of, okay, we have a question on DDR, which is domestic debt restructuring. what's the earliest that domestic debt restructuring could affect bills? We don't think, for one thing, debt restructuring, we don't think will affect bills, because globally, on very short tenor maturities, debt restructuring have not been done, simply because what happens is, if you do debt restructuring there, the liquidity in the system gets affected, and the financial system stability also gets affected. So usually you don't do domestic restructuring into bills, but you do it for bonds, right? So that's what we expect, and earliest that is going to happen, as we explained in the, while I was doing the presentation, second quarter next year is what we are looking at as the earliest possible date. Okay, so we have a question related to the listed companies. I will put you through to you, Ranjan. Which companies will benefit from lower corporate taxes on agriculture / plantations?
So what I feel is like, given that now the standard rate has been increased from 24 to 30%, there will be not much of a difference in terms of tax benefit for any of the companies. However, what we are seeing is on plantations and on the agriculture sector, plantation shares, we are seeing that we have seen serious level increase in the tea and rubber prices during the past few weeks. So with this, not just because of the rupee depreciation, but in terms of dollar value as well. So we are expecting this to flow into the plantations, while given that we have the government has also gone back on and reversed the decision on the glyphosate ban. The fertilizer issue is also not there for plantations anymore. So given these, we are expecting the plantations to benefit in the short to medium as well. For in terms of agriculture, what we are seeing is the companies that we are currently listed in the market is only a few of them is Axta and CIC. So what we are seeing on them is that given that the government has signed off on the importing of agriculture for the fertilizer for the Maha season, we expect them to flow through these companies. So, however, there is an issue in terms of getting money back from the government. But given that fertilizer is a necessity in the current context, we believe that government will give priority to the fertilizer companies and somewhat ease their problems in terms of getting money from the government. So I hope I have correctly understood the questions and catered to what the question means.
Ranjan, there is a related question to that. Can you comment on agriculture-driven businesses and the current momentum it is gaining? Because generally they are beaten by pending government subsidy payments, some with 50% companies cash flow tightening and forex shortages. So I think they are asking about again the plantation and agriculture companies, Ranjan. So in terms of cash flow, I think cash flow levels have I think significantly improved in these plantations with the higher prices, right? You have there, yeah.
Yeah, Dimant. But however, what I had to point out is that so we saw the same thing happen to the utility segment as well. So as per the if you have been following Winforce during the last couple of quarters, what they have also seen is that they have not received payments since last August for the services they have rendered to the CB. So we believe, however, what we have seen is their earnings is not getting impacted despite the not getting receivables. They may have a bit of a cash flow problem, but their earnings is not getting impacted. However, the impact is coming in terms of dividends. So if the government doesn't pay the agriculture companies on time, I don't think there will be much of an impact on the earnings side, because the government will somehow try to step in and help the companies out to bring down the fertilizer. Because if the fertilizer issue is not solved, we will go back to the food crisis that we were expecting during the months of April as well. So I don't think the government wants to get there. So because of that, they will help out with the payments to the companies. However, if we are going to see some impact coming in, it will be through dividends. Sometimes dividends can be postponed.
Exactly. So also, I think the higher taxes that are going to get implemented also, and the increased VAT levels, I think will help the government, and they probably will prioritize the payments, because this is related to food, and mostly governments are very sensitive to this fertilizer issue, and the government alone now can't import because of the credit ratings that they have. They will have to rely mostly through these private companies in terms of importing stuff. So as Ranjan mentioned, I think there is a high tendency of prioritizing payments into this segment. So there should not be a problem going forward, though there is a temporary delay happening. Yeah, so then there's another question on there was news regarding export companies being taxed at 30%. Is this correct?
Yeah, let me take up that question as well. Yeah, it is correct. So earlier, export companies were getting taxed at somewhere around 14 to 15%. Now it has been increased 30%. So if export, given that the tax has increased, almost doubled, we are expecting earnings also to get half because of this. And further, we also thinking that given the global recessionary climate that is prevailing with the high inflation that is happening in Europe and other key export destinations of Sri Lanka, we are expecting their buying power to reduce. So there will be an impact coming from demand side bill. So there will be we are expecting a double blow to the export sector companies from the demand side as well as from the taxes side, which you will see double with the implementation of the new corporate tax structure.
Thanks a lot, Ranjan. So there's this question. If all goes according to plan as assumed in your presentation, timelines for recovery, etc. When do you think central bank might bring down rates, especially as current levels yields crossing 30% are not sustainable and might be counterproductive to bring the economy back on track? So basically, definitely 30% plus interest rates are not sustainable, and it is negatively also impacting the budget deficit. So this is a serious issue, and also overall slowing down businesses as well. So because of this problem, we believe that during these 6 months up to around December, we will see bankruptcies and job losses in a large scale among the SMEs happening. So what we are thinking is with inflation showing signs of easing off, that will be the turning point for interest rates. So this is also demand driven. So because of that, we feel that there will be higher level of demand for investors to look at locking in these high rates for the longer term before the rates come down. So as soon as you see inflation starting to come down, we think there is likely to be higher demand for these 30+% yields. Also, as you can understand from our presentation, that even if there is debt restructuring, you still have a 20+% yield after putting in probably a large level of debt restructuring. So that is still good enough compared to the current alternative rates that are there in the market. So because of that, we think the demand will start coming in probably towards November, December. Probably December, if there is more news about IMF coming in, or negotiations regarding with India or China, we may see a sharp drop, but still, even if we don't see that, we will see the yields to be on a downward trend, as these levels are not sustainable, and we see that already that demand is significantly increasing, and a lot of people are looking at locking these rates for the longer term. Yeah. Yeah. So why do you, another question is, why do you assume a uniform treatment for all tenors in the event of a DDR? Of course not. So we are not expecting a uniform treatment, but what we've shown is what kind of a maximum hit basically that you can get. Obviously, different. Now, if you look at even a 40%, let's say a 40% haircut on coupon, so that will affect different bonds differently. So if you look at now, even in extension of maturity, we've seen multiple countries basically adopting different approaches to the different bonds. So the probably the shorter tenors, like the 2-year, 3-year tenors, could be doubled to 6-year, 7-year, while the 10-year bonds yields or the maturities could double as much as into a 20-year bond. So that kind of a change can happen. So definitely, what we wanted to show you was in a uniform sense, what kind of an impact is there, and which rates are, which yield would be the most beneficial one for you to invest, and what would have the lowest level of hit. So definitely we are recommending you to go into the longer tenors, which will have a lower hit, obviously. So but yes, there is the possibility of different tenors of bonds being treated differently. Right. Yeah. So according to your presentation in this economy, contraction in 2023 year prediction in the company earnings is justifiable. Yes. So basically, now what you need to understand is that even the second half of this year, we are going to have a significant contraction in GDP. And you will start, why you don't see this in the company earnings currently is because most companies have doubled their price, and so you have doubled your sort of cost of sales also. Some actually have increased the margins where you have increased prices beyond the cost increase also and increased profitability. But in a situation where disposable income is significantly impacted, like what you're seeing right now, significantly high level of taxes implemented back to back, and a very high level of inflation coming in. So naturally, you're going to have a significant decline in purchasing power, and people will be tempted to save more. That's why you're having a very high demand for these 30% yielding bonds. So because of that, you're likely to have a contraction this year, which will flow on to next year. So what we are expecting is the first half of next year to be negative, though it will start to recover. Obviously, the economy will start to recover, but that is not going to be enough to basically push inflation beyond, push GDP, real GDP beyond the last year, which means you're going to have negative GDP, and similarly, your company earnings are also going to get affected because of significantly lower levels of revenue. And we are only expecting a recovery towards the second half of next year. Ranjan, you want to add anything on there?
No, Dimant, I think you covered everything.
Okay, great. So let's move into the next question. If new tax structures will not be approved in the parliament, IMF bailout, would it be fully out? What is your view on this? So I don't think that this will be not passed in parliament. I think there's a high likelihood that it will get passed in parliament because any government who comes to power has to face this tough decision. Basically, our taxes as a percentage of GDP, as shown by Ranjan. Ranjan showed the revenue as a percentage of GDP. So is quite low. And global standard is for it to be around the 20% mark. And we are at around 8.5%. So which is significantly lower. So any government that will come to power will have to first increase taxes. Of course, the very high level of taxation that they have proposed currently in the Inland Revenue Amendment may get relaxed in the committee stage. That is a possibility, but definitely it is highly likely that it might get passed. And yes, you're correct. IMF bailout will not come because these are some of the preconditions that needs to be done. Some of course are not, some of the preconditions are of course not disclosed, but definitely these are some of the things that needs to be done. That's why it's being brought in a hurry.
Also, to add to that, Dimanta, there is another thing. One is in terms of the representation in the parliament. So right now, the Puduru Jana Peramuna is backing our president right now. So because of their representation is high in the parliament, we also believe this will also help current president to push out the new tax structures and reforms, like how we saw with the fuel bill that was passed a couple of days before. So as it was evident, we saw that the fuel bill get passed by majority votes. So we are expecting, given the dominance of Pujana Peramuna in the parliament, and they have the higher backing from, they are backing the government as well, it will get passed. The new tax structures will also get passed.
Correct. Thank you, Ranjan. There's another question on the banking sector. What would be your prediction in the banking sector next year? Do you want to take that up, Ranjan?
Yeah. So we are expecting banking sector is normally a proxy for the economic recovery, because when the economic activity recovers, the banking sector, which is one of the biggest players in the economy, is also recovers along with it. The only thing that is holding back the banking sector is the debt restructuring that is going to happen. So we have already seen a lot of banks, actually the bigger banks, adjusting their non-performing loans as a provision to tackle this debt restructuring in an event that this comes into play. So, however, as the economy recovers, we are expecting the banks also to recover with the activity building up on the economy. The banks will also feel the activity improving, and we may see banks doing profits in the mid-term as well. However, there is one thing to take into consideration, that is NPLs. So that is the non-performing loans. So we are seeing very high non-performing loans in the banking sector right now, partly because due to the restructuring, and partly because of the bankruptcies that is happening in the corporate level as well as the personal levels as well. So given the high inflation prevailing in the country as well as depreciation in the rupee that has trickled down to lower disposable incomes, we are seeing a lot of NPLs. The NPLs levels have significantly increased in the banking sector. So this is one thing to be cautious when investing in banks. If you can question in a banks that are relatively lower in terms of NPLs compared to the industry, with a high growth in both in the loan book and the deposit base, I think these will be the banks that will be growing at a fastest rate compared to the overall industry.
Exactly. Yes, so exactly. So I'll just add a few bit to that. That's the reason why we at First Capital Research are sort of delaying our push towards the banks. We're looking at mostly next year to basically be very positive on the, or bullish on the banks. So right now, what you will see, as Ranjan explained, is NPLs further rising. So already we've seen impairment increasing. That's partly because of the debt restructuring in terms of the ISBs. Now we will see debt restructuring provisioning also coming in terms of the, partly in terms of the local debt, plus the impairments happening because of the economy and the SMEs struggling and going into bankruptcy. So this is going to significantly impact the banks this year, and you can expect a very high level of provisioning this year. We already have seen this in the last quarter. You can expect this trend to continue during the September quarter and possibly towards the December quarter as well. However, depending on the IMF news on the IMF front and possible debt restructuring news, I think with that it might be a more prudent level to get into banks at that point of time, unless you're going for a large quantity of stock that you're going to buy. Hope we answered that question. Yeah. What is your straight away about two stocks, Ranjan? So what is your view on Expo and LIC by or sell? I think we can answer that. Ranjan, you can take that up.
Yeah. LIC and Expo are one of the biggest retail favorites in the stock market right now. In terms of Expo, what we are saying is we are not we are not bullish at all on Expo because we have seen freight rates coming down drastically. So during the months of this year, February, freight rates hits its all-time high of $11,000 per 40-foot container. And now it is hovering somewhere around $3,000 a 40-foot container. So this is a drastic decline in terms of freight rates in terms of freight rates. Furthermore, on top of that, there is another blow to this is the global recessionary climate. So recession, the world is currently at a very fragile climate where the world is heading for recession and inflation is topping. So with this, we may see disposable incomes of customers around the world coming down. So this will also have an impact on the trade. So it will be a double blow for Expo in terms of freight rates and as well as the demand side. However, we like to highlight that even though with the rupee depreciation, we are expecting it to normalize from the first quarter of next year onwards. So until then, we may see returns in terms of rupee depreciation. However, on a year-on-year basis, but on a QOQ basis, we may see earnings come down on Expo. On Lanka IOC, the story is different. So Lanka IOC, what we saw was during the months of May to September, Sipetco was not operational at all. So 100% of the demand was coming from Lanka IOC. So so that helped Lanka IOC to grow very fast. However, with Sipetco coming into operations now, there is a bit of a slowdown in terms of demand when it comes to Lanka IOC. However, in terms of pricing also, there's a small impact because the prices, given that the global crude oil barrel prices is coming down, we have also adjusted out based on a fuel price formula, the current prices. We have seen fuel prices coming down by over 100% from the peak that we saw during the months of August and September. So this will have an impact on the margins. However, on a positive note for LLC, what we are seeing is on a couple of days back on the appropriate budget, we saw Energy Minister Kanchana Wijasekara coming forward and saying that they are planning to increase the fuel quota for vehicles, and he was mentioning that there are around 350,000 commercial trucks that are being used currently. So right now they are getting about 5 liters per week, and they want 30 liters. So if this, if the government decides to increase the amount of liters to 30 liters, a total of around 8 million liters will flow into the market weekly. Even in a case where the government doesn't increase even up to 30, even for 20, it will have an almost increase of about 4 million. So whatever the case, it will be a positive impact on the demand, which will happen in the which is help LIOC go forward. Moreover, so we saw that LIOC also got 50 new fuel stations from the previous with the interim budget. So this is also expected to capitalize during the year of next year, and it will also help LIOC to grow their earnings in the medium term. Furthermore, there are a couple of things that are also beneficial for LIOC. One thing is the grease plant. So they have started a new grease plant as well. So this is also expected to positively benefit LIOC in the medium term, while the Trincomalee granting of Trincomalee oil tanks is also expected to be positive for LIOC in the medium term. So there are a lot of positives that are expected to flow into LIOC in the medium term. So what we are seeing right now is we are seeing some panic buying coming in for the share right now, as the share came down recently with the recent fuel price adjustment. However, we are expecting LIOC to recover and do well in the medium term with the new additions that I have said before to come into the company. I hope I have answered that question.
Yeah, so as Ranjan mentioned, so we are negative on Expo, and very positive on LIOC. So we continue to be positive. We've been positive for the last 3-4 months, and we are continuing that positivity going forward as well. So we have a question on what is the recommended equity FI allocation split as a percentage of the portfolio. So that's a bit of a tough question, and in this period of time, so obviously fixed income rates 30%, very attractive. So by doing nothing, you're going to get 30%. You can even invest in 10-year bonds. So 10 years, you're going to get 30%, which is sort of risk-free. Let's say that you have a debt restructuring coming and that you have it on that, still you'll have 20% plus return by just doing nothing. So I would say at this moment of time, if you can invest in fixed income long term, that would be the best way forward. However, in terms of allocation, I would think even the equity market is attractive. It might be a good option for you to go for a 75-25 sort of a allocation, where 75 is fixed income and probably around 25% into equity. But it's you can't just invest in equity just in the market. You will have to be very selective. We've told you what sectors will do well. So there would be sectors that would come negative, that are negatively affected. There would be sectors that are positively affected by this economic crisis. So you have to be very careful and select. But also that split, what I told you, is a generous split. Ideally, it will depend on your risk appetite. So you can't really give a split without knowing the investor's risk appetite. So if it's a completely risk averse investor, I would say even go for 95% allocation, because risk-free, you're going to get 20% plus return. Even if you're a smaller investor who doesn't have the capital to buy bills and bonds, you can go and buy unit trusts. I mean, all the investment banks have unit trusts now. For here in First Capital, we have unit trust specifically for government securities called the gilt edge fund. It's exactly similar to a money market fund, which is almost equivalent to a savings account. You can withdraw or deposit money anytime. Then you have the sort of the medium term fund, which is called the fixed income fund. So there, if you can put in money now, lock in for the longer term, this will be the ideal period. So also, on the other hand, equity market is selected shares are attractive, and we are expecting the market to move to 12,000 as well. Yeah, so there's another question on equity. I'll put that to Ranjan. Any advice for new investors in the equity market on the current situation? So in this kind of economic crisis situation, Ranjan, what would be the advice that we can give for new investors?
Yeah, so I will say if a new investor comes in, just look at the company fundamentals. Don't follow any advisors. Just don't buy into patterns. Just invest in fundamentals, because we are expecting a very volatile period ahead. So always position the companies that are in high growth sectors, such as tourism, as well as the defensive sectors where the dividend yield is high. So you will get a good dividend as well as the capital gains on top of that. So for a new investor, what I say, what I like to advise is always position in the fundamentally strong shares, where the future growth is very bright, instead of going on hunches or just trading on technicals?
Yes. So there's a question, probably this could be a final couple of questions. We've gone beyond our time also. In a high inflation, high tax rate, high interest rate environment, how do you expect the market to perform in the medium term? So I'll just take that up. So it's like this. Now, we all know that Sri Lanka is going to go into a sort of a recovery mode, and with it, inflation and interest rates are likely to come down. So what happens is, on expectation of that, selected stocks actually start to perform. So probably you will see earnings not doing too well towards December, March quarter or June quarter, but on expectation of earnings doing well towards the fourth quarter of next year or in 2024, stocks can perform. Now, for example, we are expecting tourism sector to do really well, especially on expectation of higher tourist arrivals and higher tourism spending. So with that, you would see ahead of tourists coming in, you will see significant improvement in hotel sector counter. So we've already, First Capital has published a report on the tourism sector. You can visit our website, the research section, and basically look at that report, a sector report on tourism. So all our research is available on our website. So it's that kind of thing will push the market to the next level. Also, based on the expectation of 2024 earnings, market will start to move towards the second half next year, and despite volatility, it will be on a volatile uptrend is what our expectation is. So we'll take up the final question. Will restructuring of loss-making SOE go through? If not, IMF facility may not materialize, and therefore economy may go from bad to worse. So we can't go forward without reform. So the government, the system that is existing has failed. So because of that, there's no way forward without reform. So I think SOE reform is a must, and to get IMF, some amount of restructuring has to be done. So that's definite. So because of that, basically SOE reforms need to get done, and obviously if you're correct, only if that gets done, you can go ahead with the IMF facility. Yes, Nihal is raising the hand. Yes, Nihal, you can go ahead. Hold on. Yeah, you can unmute, I think, now and ask your question.
What would be the impact on of personal income tax on the interest received on bonds? Like, for example, even 30%. What would be the, after deduction of 36% income tax, what would be the impact?
Yes. So basically now earlier it was of course interest income was having only a withholding tax of 5%. Now the normal income tax is applicable now. So some argued that yields should move up because of that, and we saw bidding also coming a bit at a higher level during the last couple of auctions. But I think the overall market recovery is going to have a impact on the yields going forward, especially if inflation comes in. Now, thing is this, no, though there is an impact on taxation, that is out of the profits or earnings that you make, right? So that is personal income tax that you have to pay. So it's unreasonable to say that yields should move up because of that. So even we saw in the last auction that central bank paused accepting, and they brought down their cutoff rates and kept the weighted averages at the same level. So we think that even the central bank is of the view that things have peaked, and possibly with inflation coming down this month and liquidity, we have seen about 100 billion improvement. The negative liquidity is improving. So with that, we may see some easing off of yields happening. Yeah. So I think that's about the maximum amount of questions that we can handle for this session. There's a lot more questions that we have on the Q&A panel and also on the earlier registered investor questions. So thanks a lot. I would like to thank all our audience for joining this forum and being active and answering or asking many questions to clarify your queries that you had. I hope myself and Ranjan managed to answer most of your questions and give the right view for you to grab the opportunities that are there in the market at this moment of time. So if you have any further questions, you can email us on research@firstcapital.lk and answer your questions. All our research is available on our website. This presentation is also available on the website. You can have a look at it. We have no restrictions. So all our equity research, economic research, and fixed income research, you can have a look at those and take your investment decisions. So we'll be winding up the session for the evening now. Thanks a lot, everybody, for joining.